Advanced Financial Modeling, Topic 10, Capital Budgeting, Learning Objective number 8. We're going to compute Equivalent Annual Cash Flow, EAC, and understand how it's used to evaluate projects. All right, so what I'm going to show you is a method for evaluating projects of different lifespans. And it's always an example of a mutually exclusive decision, meaning you have to choose investment A or investment B. B can't do both. And those projects both have different lifespans. All right, so here's a really clear-cut example. You need to buy some light bulbs. Say you're Disney World and you have 1 billion light bulbs, okay? And you can either choose between this cheap, short-lived incandescent light bulb or this expensive, long-life, expensive light bulb that saves electricity. So if I use NPV analysis, I'm going to show you is it's going to fail. It's going to give you the wrong answer once we account for the lifetime of the actual investment. So here's the example. We'll go to a spreadsheet. I'll just go with the numbers first. So that cheap light bulb cost about $1. All right, so it cost about $1. And then it costs $2.50 per month to operate and lasts about 4 months. All right, and that's based on current rates of electricity at the time of this analysis. So it's a cheap light bulb that you spend $2.50 a month on electricity and lasts for 4 months. Or you can buy that expensive $5 light bulb that has the same amount of lumens, same amount of brightness, but those light bulbs here, these fluorescent light bulbs, operate at much lower electricity costs, and that particular one is 38 cents for the same amount of brightness as this one, and it lasts for 40 months, 10 times longer. So what we're going to do is calculate the NPV just looking at what we have so far. So when I do that, going to the spreadsheet, you see that if I spend $1 today, and then I just have an example here of $3 of electricity per month for the next 4 months. I calculate the NPV of that investment. And since these are months, I take my discount rate and divide it by 12, calculate the NPV. So in present value terms, it costs $12.80 to operate this light bulb for 4 months. And then this fluorescent light bulb that costs $5, and electricity is 45 cents based on the latest rates here, but it lasts for 40 months. When I calculate the NPV of this light bulb, it's $20 versus 12. So you'd say, well, this is the cheapest light bulb, but that's not fair because this one lasts 10 times longer. Well, I guess to make it apples to apples, I could just keep putting in the repurchase of light bulbs here, and here. But here's a simple trick. If you have a mutually exclusive investment in which you have unequal lives, first calculate the NPV. Then spread the NPV as a payment. So notice I did a payment function. I put in the monthly discount rate, and I say four periods, and where it says present value, I put in the NPV of the light bulb. And what that says, it makes equivalent a 4 monthly payments of $3.25. This other light bulb, I create 40. I can get 40 payments, and the present value of $20.75. It's 40 payments of 55 cents. So if you really think about it on a per period basis, this light bulb, this cheap light bulb, is much more expensive. So whenever we get the situation where we have projects of unequal lifespans, calculate the NPV, and then plug it into a payment function where the number of periods is the life of the project and the present value is the NPV you calculated in the first stage. And then here's just another example. Do you buy machine A, which is cheap and lasts for 3 years, or machine B that's expensive and lasts for 5 years? You only can have machine A or machine B. It's mutually exclusive. I made some assumptions about the project. You know, the first one cost $100, depreciated over 3 years, has a salvage of 25, requires OPEX of $75 per year, tax rate of 25%, discount rate of 10%. So when I do those cash flows, it cost me $100 today. And then I did the after-tax OPEX, I did the depreciation tax shield using that shortcut method from before. So the free cash flows in years 1, 2, and 3 are 47, 47, and then 29. Now notice this 47, I could have done it the long way, the long painful way, by doing an income statement right here. Zero revenue, here's my OPEX, depreciation, EBIT, take out taxes, add back depreciation, get 4792. But all I had to do is take after-tax EBIT, which is my OPEX, and then just and add back the depreciation tax shield. That's the benefit of the depreciation. So I just want to show you both ways to do this one. And then this other project, it just lasts for 5 years and has different costs. On an NPV basis, the NPV of the machine A is 205 for 3 years, and the NPV of machine B is 260 for 5 years. But I convert both of those to payments. I convert machine A to a 3-year payment of 82, and this one to a 5-year payment of 68. Now it's clear that machine B is cheaper. So I'm going to go with machine B, even though it has a higher NPV, but it lasts longer. All right, so that is a nice little trick to have in your toolbox when evaluating projects of different life. And this shows up in life and in business all the time. You always have a choice to buy a cheap, short-lived asset and an expensive, long-lived asset. And this is a way to try to reconcile and get finance to tell you the answer. Okay, so that's it. That's topic 8.